Everything you've been told about dividends is just not correct. It is not true that dividends are safe money, they are not passive income, and definitely they are not the best way to achieve what we probably want. So financial optionalities, one day ideally financial independence, thanks to our equity portfolio. In this video we're going to prove how and why dividends are overrated, in some cases overhyped, and why they are actually putting your portfolio in danger. Finally, we're also going to be seeing a way better option, and the world is not chosen randomly to achieve what you want. If we haven't met before, my name is Francesco Ferrari. I'm an independent equity investor. I've been investing in the stock market over the past 6 years in individual holdings, achieving a performance of plus 27.8% average annual returns, a performance that I update publicly every single quarter across my social media and social channels. I am also a licensed financial educator and coach, and everything you're going to be seeing here is intended as educational content, of course. This video is also inspired by three legends, three popular investors I am sure you know: Warren Buffett, Terry Smith, and Pat Dorsey. Why am I saying this? Because they actually share a very important principle, an unwavering modern value investing principles. That brings me back to the first point here of today's story, which is the capital flywheel. These three investors always say they are not against dividends, but they always say, why should you pay me a dividend, interrupting the 20-30% return on investment that you can generate internally by simply reinvesting the earnings and the cash flows of the company inside the business. It's not a case that Berkshire Hathaway doesn't pay off a dividend. It's not a case that Terry Smith with Fundsmith doesn't even invest in dividend companies. And it's not a case that Pat Dorsey has always preached with his philosophy the importance of capital allocation, of organic or external growth, by reinvesting the vast majority, if not the total earnings generated by a company internally for the growth of the business. That is a super important principle that explains the first problem that I want to highlight here with dividend investing. Last time we mentioned the importance of the capital flywheel. What is this? Is the one and probably the most recurring pattern of winning stocks, of quality compounders, companies that keep reinventing themselves and with their underlying share prices going up for years, if not decades, and generating life-changing returns. And what's behind these returns is the capital flywheel, which is a pretty simple but really important concept to master here. And today specifically, it's important to understand why dividend investing actually breaks this positive loop. Because when our company is growing revenues in thriving industries, they capture new markets, they launch new products, they gain market share, whatever. That is the first point, which is of course mandatory, unwavering. But what happens when they actually turn these revenues, this top line growth, into operating cash flows, OCF, which is perhaps the most important financial metric to monitor in the stock market as stock market investors? Achieving this, it's the first milestone. But what happens next? The flywheel involves a situation where the operating cash flows are reinvested into either intangible investments, research and development, sales and marketing, even equity compensation with stock-based compensation, or in growth tangible capital expenditures, the CapEx, which is a line that you can see in the cash flow statement. But either way, it's super important that you take the operating cash flows and you keep reinvesting inside the business, especially if you're able to generate a 20-30% return on invested capital. Because let's say, as Terry Smith would say, that this company breaks the flywheel and instead of reinvesting in CapEx and R&D, they decide to pay you super generous dividends. Are you able to generate 20-30% with that same amount of money? Probably not. Probably not. And this is why it simply makes sense to avoid the dividends, keep reinvesting, and whenever you want the money or you need the money or you want to give yourself a gift, just sell a bit of shares. I don't do that. I do it this is pretty rare. I've done this twice or 3 times over 6 years. But if you want to enjoy your personal dividend, just sell a bit of shares and let the company reinvest and keep activating the flywheel. Because what's the consequence? We always say that a successful stock must have control, which is the absence of risk and the presence of quality leading indicators at the same time, profits, and a company that pays off dividends usually has the profits, and growth. But growth is the third element that is put here in danger whenever you decide to become a dividend stock. Because by avoiding the CapEx and R&D investments, you are breaking the innovation spirit, you're interrupting the launch of new segments, new products, new IP, and the company simply becomes a cash cow, a boring business, a boring, predictable business, which likely won't add anything new, anything exciting for institutional investors who, however, love surprises, innovation, things that they didn't expect before. So when you kill the reinvestments, you are killing innovation, and you are essentially generating a situation of no or very little revenue surprise. And we know there's plenty of studies around this, that share price in the long run, in the medium to long run, are just a factor of revenue surprise, earnings surprise, exit multiples, and number of shares outstanding. By paying out dividends, you are killing the revenue surprise side of things together with the new earnings. And if the market is not able to see or to appreciate anything new, the business remains the same, the story remains the same. Probably it starts decelerating, then the risk of a dead stock is very, very, very high. That's the moment where the compounding itself interrupts and great stocks become dead ones. The second point that I want to make here is the consequence of what we already said. Because by choosing dividend investing, the big risk from a life cycle perspective is to only pick companies that are either in their maturity or declining phase. They cannot reaccelerate because they don't have the R&D culture, the capex culture. They keep the earnings, they don't reinvest the earnings, they pay them out. And so the doors of a reacceleration, the likelihood of a reacceleration drops dramatically. And that's the whole point here. Because let's say that you have 50K, 80K, 100K, 150K to invest in individual great companies, or you're already doing that probably if you're watching this video. You probably want to bring those that money, you want to 3x, 5x, 10x that same money to eventually one day enjoy the dividends, enjoy the income that that portfolio is able to generate. But the temptation of investing in dividends today is killing your dream, is making your dream impossible, because you are essentially picking dividend companies in the worst possible time of your investing career, and you're picking stocks at the worst possible time of their life cycle. So in one shot, you are preventing the compounding, which is phase one. Phase one, grow your portfolio to a point where eventually it can generate a lifestyle from the income. And you are basically choosing dividends today to enjoy a very slim, a not remarkable impact from the dividends. So the risk of choosing companies at maturity or worse in their decline phase is to kill the compounding up front to enjoy a small dividend today, which is the worst thing that can happen. You'll never win the cake. You are breaking the compounding today. So if you're in that stage, 5 figures, low 6 figures, forget dividends. And what I'm going to cover next is another example of why am I doing this and preaching this with some specific data points here. So when you are chasing dividends, in the best scenario, you will probably are going to get like 3, 4, 5, 6, 7% per year, which is already astronomical when it comes to dividend investing. Typically, what I've been observing is that beyond 4, 5%, that's where the problems start. And that's where you start approaching the high dividend yield trap. The high dividend yield trap is a serious risk, especially for beginner investors. Probably if you are a little bit more experienced, you've already experienced that, but this is a point that we need to cover here because I still see so many financial influencers or posts or ideas around high dividend yields, the idea of getting paid passively every month with companies paying 10, 12% yields. This is a very dangerous approach. This is super dangerous, and I'm gonna explain why now. The dividend yield, as you may already know, is the dividend paid per share divided by the share price. So if the share price is $100 and you have a dividend per share of $4, the dividend yield is 4%. That is exactly the same of saying the total dividends paid by a company, so the whole chunk, divided by the value of the company in the market, so the market cap. That is exactly the same. I like having this last one, this last fraction, because for me I can picture this a little bit better. but it's the same story. When you see a high dividend yield, you are fooled because the dividend per share remains the same over time, and it's the stock price going down that makes the yield go up. So the stock price is going down for some severe market fundamental problems, that the market is perceiving. So the flow is, there are some business issues, the stock market understands these issues, the stock price goes down, the denominator goes down, and the entire fraction goes up, meaning the yield all of a sudden spikes up, attracting investors who are interested in the income side of things. But you will it's super straightforward to understand that the yield being so up, it's because of a share price going down, which reflects business issues. And we always have to avoid this situation because the ultimate risk is the dividend being cut because of the business problems. Probably the business is shrinking, the cash flows are going down, and the dividend will become unsustainable over time. If that occurs, oh my lord, that would definitely cause a collapse in the share price. We saw that with Walgreens Boots Alliance a couple of years ago. It is not a case, it's not a coincidence that the stock was, basically the company went private and the stock went unlisted. So to prove that to you with a small piece of research, very quickly, we tried to prove this idea of the high dividend yield being a danger for you. And we selected a basket of companies. We did a test here. We isolated in the US only those companies paying at least 4% in terms of dividend yield, maximum 10%. So we eliminated from the basket those companies which pay out these pretty insane dividend yields of 20, 30, 50, 70%. Those were just outliers. So we cleaned up the list. And to balance out things, we only selected companies. So we implicitly cut off all those companies in a decline phase with declining revenues over the past 10 years, because that would have been too easy, okay, to demonstrate the ineffectiveness of high yields. So to be fair and to keep a clean basket of companies, we filtered for flat or positive revenue growth in the past 10 years, remaining in the maturity stage here. All right. And nonetheless, this basket of companies only delivered 1.16% average annual return per year, despite the 5.78 dividend yield, which means that in reality, this basket returned negative 4.72% return per year, which is crazy to think about, right? Because to achieve the 5.78% dividend yield, you are destroying value every single year. You're destroying the underlying capital because the returns are negative. And it's like choosing a cake for the cherry on top, but getting a cake which is poisoned. So you're getting poisoned by your cake. And this is not what we want, of course. By the way, there is something I wanted to tell you here. The high dividend yield trap is one of the multiple factors that are recurring reasons, recurring elements of what we call value traps in the stock market, meaning companies that are apparently attractive or appealing for whatever reason, valuation, dividend yield, or other factors. But in reality, they are hiding severe business risks and traps. Down below in the first link, or in the description anyways, you will find a brief document, a one-pager with all the reasons, all the factors that you can use to quickly spot value traps, all taken from experience, from real cases, and in many cases also many times from the mistakes that I've made initially or even in the past few years. So value trap checklist, link down below. Check it out. It will save you probably some mistakes. Moving on, I have to say that there are actually two situations where we welcome dividends in our investment process inside AlphaZen, our private program. But anyways, in our process in general, there are two situations where we actually allow dividends to enter our world, and you can see them here: the dividend kings and the dividend growers. We're going to cover both. Again, it's a conversation, and let me walk you through what's the plan here, what to do, what to avoid, once again, because these two groups need to be treated differently, and as you will see, I am more inclined to one of the two. The dividend kings, by definition, are those companies which that have been increasing their dividends steadily over the past 10 years. In some cases, in financial literature, you will see a different time frame. It can also be 30 years. But in our case, we stick to 10. Examples are Marriott International, McDonald's, Eli Lilly, Waste Management, KLA. And you start seeing the difference in quality, meaning this basket of companies here is definitely a quality list with companies that have been dominating their industries for decades, and they've also been rewarding their shareholders with increasing dividends year after year. We did the same test. This time the financial criteria were a little bit stricter because we filtered for revenue growth of at least 3% compounded, gross margin of at least 30%, and the current free cash flow percentage of at least 12%. We analyzed this new basket here, and we saw that the CAGR, the compound annual growth rate of the stocks, was 13.69%, which includes a plus 1.65 of the dividends. This is still lagging the S&P 500, which in the same time frame returned 15.02 by the time I'm recording. But this is still interesting, especially for those perhaps 7 or 8 figure portfolios seeking lower volatility and more business stability, even though this is a very dangerous word. And why is this a very dangerous word? Let's talk about the risk of this cluster of companies. The reason why I don't prefer this over the last group, which we're going to mention in a bit, it's the price for perfection risk here. Because if you notice, these companies, they all trade a very generous forward multiples. Forward price to earnings or forward price to free cash flow. 42 for KLA, 30.5 for Marriott, 28 for Waste Management. Forward multiples that are above the broader market. That creates a tension, and the tension is what I usually call the being priced for perfection. So the expectations, the trust, the respect, the enormous respect that the stock market has for these companies makes the tension too high for me, meaning they're trading so rich, and this creates a situation where what happens at the first sign of weakness? What happens if for any reason they all of a sudden decide to not raise the dividend for the next year? What if they interrupt the pattern? What if all of a sudden the spell is broken? Okay, the magic is broken. It's like having a warm cake, right? The cake is beautiful, it's not poisoned like before. The cherry on top is nice, 1.65% dividend yield. But the cake is warm. At any given time, it can break up in 1,000 pieces in case something breaks, in case the dividend doesn't get increased, or revenue stalls, or whatever reason. This is why for me this is always good practice to be very cautious with this type of companies, at the cost of missing out on actual compounders. But as always, risk wins over reward, and risk is what we should be obsessed with, not reward. Dividend growers, it's the actual group of dividend paying companies that we favor the most inside AlphaZen and in general. Dividend growers are simply companies that pay a tiny dividend with a very small payout ratio. So what is the payout ratio? Take the chunk of earnings that a company pays off for their shareholders in terms of dividends, let's say 100. And if the total dividends paid is 20, the payout ratio is going to be 20%. And by definition, the dividend growers, they have a payout ratio which is maximum, which is capped at 20%, which means that they actually can reinvest at least 80% of their earnings, their operating cash flows, inside the business for organic or external growth. That is the situation that we want. And also there is a market mechanism around this, because whenever the dividend yield is low, this means that the probability, the likelihood of the dividend being raised over the next few quarters or years actually is higher. The likelihood goes up. And we know the stock market lives off surprises. Institutional investors love surprises, things that they didn't price in yet in general, whether this is about revenues, earnings, or even dividends. So imagine a company like Nvidia, Meta, or even Salesforce all of a sudden announcing a dividend raise, an increase in the dividend. That would be an unexpected positive news that would also drive the stock price up, because once again the likelihood of a dividend being raised is way higher when the dividend is very small upstream, and that's the opposite situation of the dividend kings, because when the dividend is already high, it's been paid for 30 consecutive years, it's stretched, maybe the payout ratio is 50, 60, 70, 80%, you are borderline there. And it's way more probable that this situation breaks compared to this one. We have done the same test. We've isolated a basket of stocks with a payout ratio lower than 20%. At the same time, we've identified increasing operating cash flows. So we were a bit stricter, more severe here. But anyways, this cluster of companies, which is one of the which is definitely very interesting quality criteria, is one of the 25, 28, now 30 criteria inside quality idea generation in our investing process. The cluster has generated, maybe you don't see it well, but 17 plus 89% average annual returns over the past 10 years, which includes a 1.06 of dividends, a 17.9, which is higher than the 15.02% delivered by the S&P 500. And so that is a winning basket of companies. And it resembles perfectly, it perfectly represents what we want to have. The absolute North Star, the absolute holy grail of investing, of peaceful Zen investing, which is investing for superior returns without turning this into a second job, which is performing 2, 3, 4% per year more than the stock market, because we know that over the medium to long term, this is going to produce incredible results for us. 2 or 3, 4% per year is definitely everything that we need to produce a result over 10, 15 years, which is 3x, 5x, 7x, 10x more than what the indexes can do. I'm gonna leave it there. I'm gonna throw it there with what I mentioned initially. The better option, and the word option is not taken randomly, to achieve the equity income generation goal that we mentioned before. Let's start with our lifestyle cost. It depends on your country, on your personal taste, needs, on your lifestyle in general, of course, but let's say that in general 60 grand are enough to retire and to live decently. 60 grand per year. Dollars, euros, pounds, whatever you want. If you're choosing a dividend strategy as passive, very dangerous word, income strategy, and assuming that with dividends you're gonna get 4% per year, which is already very generous, a healthy dividend strategy will not likely grant you 4% per year, but let's assume that. Well, actually you will need 1.5 million in the underlying capital, the capital you need to stack before starting generating the equity wheel, which is 1.5 million, once again. But if you decide to opt for another strategy, and the other strategy is what we call the intelligent wheel strategy of the value investor, topic for future videos, there will be time to talk about this, of course. But if we've done a great job as modern value investors, identifying 100, 200, 300 quality compounders, having the exact entry price targets and the exact exit price targets, so having these two sides, well, actually these three elements, a long list of quality companies with their interesting entry prices, the prices that would set these stocks as asymmetric in our favor, that we would be anyways happy to own the stock regardless of what happens in the stock market. And finally, thirdly, having this list of bull target prices, what we define the bull target prices, meaning at what price are we happy selling, getting rid of the stock. We've already done everything, because for the wheel strategy, again, topic for another video, but with the wheel strategy, all you need to have is quality companies you would own anyways, an entry point and an exit point. The entry point becomes the strike price of your cash secured put. The exit price, or somewhere near that, it becomes the strike price for your covered calls. I'm gonna leave it there, but that's everything that you need. I just want you to know that with options, you don't need to be a trader, or you don't need to spend hours on the screen of charts. The intelligent option selling for value investors is the last part. Identifying the option, the contract, is the last silly part of all the entire process that we've already done before of researching, skimming, filtering, and validating the quality companies that can be part of our investable universe. And you may want to trust me on this, but with the intelligent wheel option strategy for value investor, you can generate between 0.7% and 1.3% per month. This is a pretty safe scenario, but you can generate even more if you learn how to roll options. But let's not deviate. With a safe wheel option strategy, you can generate between 0.7 and 1.3% net per month, which equals to 9 to 15% per year. I just took the average, so I just took 12% per year. And I'm going to ask you this. If you can generate 12% per year semi-passively, if not passively, instead of 4%, what happens to the underlying capital that is necessary to trigger that financial optionalities? It's 3x less. You're not going to need 1.5 million, you're going to need just 500,000, 500K. That is massive. This is years of investing. This is years that you win back, that you gain back for yourself. Of course, it depends on so many things, so many factors. I will not probably interrupt the compounding here. I will probably decide to keep the compounding, to let the compounding go and aspire to even more ambitious goals. But that's just me. This is just a point to make that I'm making here to making you visualize how overhyped dividends are compared to options when you are a modern value investor who knows what he's doing or she is doing. That is very important. So if you want to learn more on how we actually invest, pick stocks, set exact prices to entry, exit, trim, or whatever, selling, holding, buying. If you want to see a whole, complete, modern value investing process, smart frameworks, smart tools, and even fun, I would say, but this is what my students say actually, check out AlphaZen. The link is in the description. This is how we invest, and this is how you can start investing directly under my supervision to pursue what we all want. So compounding our well-deserved savings, be part of exceptional elite companies, and always obsessing with risk. So protecting our downside to letting the upside speak for itself. I hope that was valuable. I hope there was one nugget here in this video that you could take away from it. Let me know in the comments below what you think, what are your thoughts. Comment, say hi, and show your appreciation or love if you have it. So that was fun. Thanks for sticking around, and I see you on the next one.